Right now, this is my portfolio trend. This is since inception, yeah. So portfolio near all-time high again. So yay, market hot lah. So it's like we have a crisis, flash crash, the Liberation Day crash, right? Then so fast we are back to near to all-time high again. But this is portfolio value, not stock market index. So portfolio values will include the money that I put in during those period, right? So definitely it will go back to all-time high faster than the market. So that's a good thing. We always deploy all the time, right? But just for your information, I haven't really deployed in a big way during, let's say, like April and May. So I bought a bit, but not a lot. So, and some more, let's say, at this current portfolio size, right? If I put in even, like, let's say, 5,000, 10,000 inch, right? You can't really see it just because of the portfolio size is already larger compared to the amount that I usually put in on a monthly basis. So that's a quick update. It looks pretty, right? I mean, let's say if you just zoom out, when you look at the chart, it's like only up. There are some drawdown during the period. It's just that if you zoom out, you almost can't see it, right? It's always up only, or everything looks good. But actually, if you zoom in, right, it gets quite scary. This is just the year-to-date view, right? So you can see that around end of 2024, the markets was quite good. And then from April, you can see that the drawdown is actually quite steep, right? So portfolio down about 200,000. I also get scary. If you watch my video around April, I would say that, because of the trade war, I mean, things can get worse, right? Of course, whenever there's any crisis, right, things can always get worse. Not will. So this is always probabilistic kind of things. Like it can go up, it can come down. And to be fair, I have to say, when it comes to my predictions, if you ask me to predict during April, will it get worse or not? I would say yes, likely it could come down, right? But it seems that after the trade war pause with China, things get a lot better. So market already rebounded. I won't say that this is one way up, right? So I mean, always you need to see things as it can go up, it can come down. It's always the case. So if you invest in stock market, right, whether it's like trending up, you also guess like, it might, U-turn back down, or it is crashing down, it might reverse, right? So who knows? But short term is always difficult. But if you zoom up and look at long term, right, I think long term wise, things usually turn out to be okay. So that's the things that we can bet on. So just a quick one. I won't go into a lot of details. Just put this as a snapshot for those who are new to my channel. You can look at my portfolio. The largest positions is Nvidia, and then followed by TSMC, Tesla, Microsoft, Amazon, Apple, Tencent, Google. And then I have some ETF positions, right? It's like IUIT, this is technology ETF. And the QQQ, also quite heavy on the technology. Then all those IWDA, CSPX, ICHN, these are really broad-based ETF that focus on either MSCI World or S&P 500. ICHN is China. And then I have a couple of smaller positions like ASML, Berkshire, and Meituan. These are quite small. So this is my current portfolio. I think there are quite a number of new joiners in Telegram group, right? So I guess quite a number join after they watch Contra Turtle videos. And then they likely, you guys don't know me, because actually I have been creating YouTube videos for quite like a number of years already, but the channel is very small and not many people know about me and know about my channels. So I will just take like a 5 minutes or 10 minutes just to walk you through what's my investment approach, just for those who are new. Let's say if you are not new and you just want to skip ahead, maybe you just skip ahead after I complete this segment, right? I will talk about just a quick update on Nvidia, because that's the company that released their earnings. So, okay, come back to my approach, right? So as you see here on my portfolio, so I invest in a mix of individual stocks, meaning stock picking, and also I have invested in like broad-based passive ETF. These are the ETF like S&P 500, QQQ. Those I call it like a broad-based. Okay, some are broad-based, like just target the entire world. I also bought some, like ETF that tilt towards technology. Say for example, that the IUIT, QQQ, these are tilt towards technology. So it's a mix of ETF and individual stocks. But I think the key things here is that after I buy my into whether it's ETF or stocks, I rarely sell. Like almost no transactions on sell. I will do some changes if needed, but this is usually like I do it once every, let's say like 2 to 3 years. So it's very infrequent. The buying part is more frequent. It's like I follow approach closer to DCA, meaning dollar cost averaging, but not like very fixed every day of the month kind of like DCA. It's more like consistently buying every 1 month, every, let's say 1 or 2 months, I will buy, consistently buy. And what I buy is usually buy into my existing companies. And sometimes, let's say if I have new ideas, I might also buy into them. But that is also very rare. The key thing here is buy and hold. And the reason why I created this channel is also because when I look at the, like Telegram group, right? People always talk about like, oh, buy, sell, buy, sell. I do this, the idea, short term, do a trade, and then buy now, 2 weeks later, sell already. So this is very common among stock market investor. They call themselves investor, but I call them traders. So because it is too frequent, right? In, out, they don't even have time or bother to spend time to understand the companies in detail. So that is not my approach. My approach is like, I would rather own a smaller subset of stocks, but those are the stocks that I understand in detail. That's why, let's say, if there's any crisis, I can understand the situations better than average people's, right? So that helped me in terms of like having this ability to hold and not panic about my positions. Basically, that's my approach. Like I said, I avoid frequent trading. I know that this is quite common, even for those who buy stocks with the intention of buy and hold for long term. Then suddenly there's a market crash, let's say like the Liberation Day, right? The trade war, right? Then they get panics for whatever reasons, right? They get out of positions. I think this is very, very common. It's just that for me, first thing, I'm not good with all these trading things. Like I don't know how to read chart. So that's not the game I want to play. Let's say if you are trading, right, I would suggest that you have to assess your ability of trading. Like, can you really have good results, right? You have to compare your result versus buy and hold on, let's say like S&P. And let's say if you are good, I mean, you can continue, right? Let's say S&P give you average of 8 to 9% per year, and you can generate 20% per year, right? I mean, go ahead, right? But I would say that actually most people are not good at trading, because trading require a type of like mindset that is not common one. Like most people, right? Let's say if you are just average person with average emotions, right? Your brain is built to be sucks at trading one. So I think this is average people, they are sucks. But there are small group of people who are very good. For example, they have some sort of system, very, very disciplined. They have no emotions when it comes to trading, and they follow their rules very, very tightly, and they know about the risk management when it comes to the trading, right? I mean, they are very, like, let's say I'll call it maybe just 1 in 20, 1% out of 20 that's really good. And these are the people that can close to profit from trading consistent manner. By consistent, it's not like every month they can profit. It's more like, let's say out of 5 months, they can profit 3 out of 5 months. So, and the gain is more than the losses, right? Then they can continue to do that, right? So for average people, I would say that you have to look at your result and then assess whether you are good or bad. It is okay that you are bad, just like me. It is okay. You just need to realize that early and then stop doing that, and then adopt approach that will work for you over the long term. So for me, I would think that the approach that will work for me is like just long-term investing, buying businesses that is great, that is generating profit, generating cash flow, and then just ride on this trend over the long term. But you also need to be realistic when it comes to your expectations, because let's say if you just buy S&P 500, right, and you want to get like 30% per year, right, that will not work. Because let's say if you just buy a whole bunch of business S&P 500, you should expect somewhere around, let's say 8 to 10% per year. That is over a long period of time. Of course, from time to time, there will be drawdown. And if you are able to buy during those periods where people are panicked, then likely you can get further upside from there, because people are selling at cheap prices, right? So I think that's the difference between trading and investing. You really need to know the difference between these two. They are completely different. So as I mentioned, right, most gains, right, came from just staying invested, watching paint dry, meaning that you have to be very patient. We are all waiting for the growth, but not in the growth of share price. It's more like the growth of the fundamentals. For example, the companies is coming up with new products, coming up with new way to create more growth. Their revenue is growing, their incomes is growing, their cash flow is growing. That will eventually translate into growth in share price. But all these things, right, it actually takes time. It's not like you do it now, over the 6 months, you can see the results. Because over a short period of time, right, the things that affect the market is actually those macro related things. Like, for example, what is driving the news market, right? What are people paying attention to? For example, like lately, it'll be all the trade tensions, all this announcement between, let's say, like Trump and Europe, Trump and China. There's all these things that drives the market, or even, let's say, like war. These are the things that drives the market sentiment over the short term, right? But over the long term, say for example, like your horizon is like 5 years, 10 years, 15 years. All these short term fluctuations, right? They won't stay one. It will keep on move on like to the new topics. But if you own a business, right? The business running every year, right? Likely their business model won't change within, like, let's say 1 year or 2 years. Most likely they are doing the same thing again and again. The difference is that their revenue has grown a lot larger. For example, they have expanded to a new market, or even in the existing market, they are increasing their market share. Or even, let's say the market share doesn't change, stay the same, but the overall market become larger, right? As population growth and so on. So all these actually contribute to the growth in terms of the business size. And your share price also will follow as long as you pick the right companies. So like I said, I invest in businesses that provide products and services that people need. It could be, let's say, like Google, right? Google provides services. Search is a services. Advertisement is a services. Let's say I invested in TSMC. These are also services in terms of like these manufacturing services, right? They manufacture for their customers. So all these manufacturing, in fact, they run like 24 hours a day, like never stop one. Their fabs keep on running, keep on churning up with all these chips, right? And these chips will be sold to their customers, and then it will fit into the products that we use, right? Say, for example, this is smartphones, right? So they will continue. These are the things that people demanded, and people pay money to get all these product and services, and all these monies will flow to the companies, and companies become larger over time. They have more resources over time, and the worth also become a lot higher over time. So this is the one that we are betting on. Of course, you want to be sure that the company is winning, right? So you can track the company's revenue, their earnings, their free cash flow, whether they are growing. Because if a company is not growing, right, it means that you need to watch out already, because it might be in an industry that is being disrupted by others, or it might be in an industry that is like become smaller and smaller just because it is not a growth industry, right? In those cases, you want to be careful, because usually the whole economy is growing. There are companies that are winning, and there are companies that they are dying. So you need to be careful on not to select companies that are dying, because make sure that they are growing, right? I think that's how we protect the purchasing power, the cash that we have, right? Because let's say if you have cash, you just hold cash, you just, let's say, earn some interest. Let's say in Singapore terms, right, SGD, right? Even if you earn 3%, 3.5%, that is really not enough to offset the inflation, because purchasing power of all this cash, right, is guaranteed to lose, let's say, like 100% of the value, not 100%, let's say 80 or 90% of the value, as long as you hold that long enough. Because, for example, let's say your interest is 3%, inflation is like 4 to 5%. Every year you are losing 1 to 2% easily, 1 to 2% for 1 year, that's fine, no problem. I'm happy to hold some cash, let's say for emergency cash, right? I'm happy to lose 1 or 2% given, and I know that this cash, right, is there. Let's say if you own a stocks, right, it can fluctuate more than 2% any given year, right? But if you hold significant amount of cash for a long period of times, right, let's say longer than 10 years, right, even 2% per year is very, very high tax, because you will notice that, these things, it just cost, let's say, like $200 10 years ago. Now you just check the price is already $320, right? I mean, between $200 to $300+, that is not things become more expensive. That is actually your cash become worth lesser. So that's the problem of those who don't invest in businesses or assets that is able to hold their value. Because businesses, right, they can always, for product or services that they deliver, right, they can increase their price. And as the cash become worth lesser, right, they just mark their services higher, right? So that's how they maintain the purchasing power for the shareholders. But let's say if you own properties, I think property is still okay, because properties prices tend to go up over time, right? So if you hold your assets in hard assets like real estate, right, I think that's also fine. The only thing that is not fine is cash, because cash, if your horizon is very short, we are talking about like one year or less, right? Cash is the safest instrument. But over a long period of time, cash is the most risky asset class that you can put in. But let's say if you look at your overall net worth and you only have, let's say, 10 or 20% in cash, I think that's fine, because everyone, you need to have your emergency saving, right? But let's say if you have 80% of your assets in investment that doesn't go up in value together with inflation, right? For example, like cash, right? Then you need to be careful already, because inflation is your enemies, not the short-term volatility, you know. So that's the thing I want to mention. That's why when it comes to the saving that I have, right? Of course, I have some cash. I mean, for emergency situations, I even build up some cash. You can call it as war chest, right? I can deploy in the market. Let's say when there's opportunity to buy at a attractive price, right? I do have like this kind of amount. It's just that it's not big. Most of my saving are actually in stock market, aside from the property that I stay here. Okay, so that's overall strategy. I just want to give a comment, like similar to the concept that I just mentioned about, like, you know, all this short-term volatility versus long-term things, right? My friend shared this with me. I think this, I don't want to, like, you know, quote the names, but he just shared with me, say that, okay, there's a message from Telegram says that stock go up, stock go down. Those invested in Nvidia via just buying and hold for past 6 months, like wasted almost the same price. And I look at the price, actually it's true. If you look at 6 months or you look at year to date, right? Actually, Nvidia stock price has been flat for 6 months already. For those who put their money in the stocks like this, right? And then you just wait for 6 months and it's not growing. Even if you put in high rates saving account, you also can get on annualized basis, let's say 3% plus, right? Here you get 0%, just, you know, waste of time, right? I see this kind of comment quite often, and I won't say it is wrong, because I mean, fact is fact, right? You put your money in companies and then they just don't grow for 6 months. I mean, time wasted. All these are fact. The perspective is different, where the person is looking at this and just think of time wasted. For me, I invest in stocks. I'm happy to hold for, let's say, like 1 year, 2 year, 3 year, 5 year, right? To me, 6 months is just very, very short. That's why my counter, right, to this kind of statement is that you look at the difference in terms of the perspective, right? So this is my counter, right? My counter is that I mentioned I invested in Nvidia 5 years ago. The annual revenue, right? Annual revenue, we are talking about 12 months, right, was $11 billion. Right now, right, today, like the recent quarterly earnings just came out, right? They generate 44 billions of revenue in just a single quarter. So quite funny, right? Usually between annual to quarterly, you need to divide by 4, right? If the company is not growing, they are generating, let's say, $2 to $3 billion per quarter. But now it's already 44 billions. So that is the growth that we are looking at, right? Okay, now the difference in terms of perspective, right? First, the person is looking at price chart. So it's all talking about like share price. When I quote these kind of things, right, you can say that I'm bragging. Yes, I'm bragging. I brag about, like, I chose the right stocks 5 years ago. So that's the bragging part, right? But I don't want to brag about the share price. Like, I mean, share price is just the things that follow. The correct things here is that I bet on the companies that is able to grow so much in terms of their revenue. So one side is share price, the other side is the fundamentals of the business. Like, take revenue as an example. I mean, you can look at revenue, or you can actually look at, let's say, net income, free cash flow, operating cash flow, whatever metrics that you want to compare, you can look at those. I think they are all telling you about the fundamentals of the business. So one is on the share price, the other on the fundamentals of the business. So two different, like this is the difference, right? The other thing is that the person is looking at 6 months. Actually, you can just zoom out, right? Look at, let's say, past 1 year, past 5 years, and click the max button and just compare, right? But to me, that is not important, because to me, you need to look at a period that is long enough to see some results. If, let's say, if you just focus on fundamentals of the business, right, and you give yourself 6 months, right? 6 months is just like 2 quarterly earnings. It's like, okay, 1 earnings, 2 earnings, that's it. When we follow the companies that we invest in, right, 1 quarter is just like 1 bar, right? Later I will show some charts from Nvidia, and we are following this for, like, let's say, like 4 bars, 8 bars, meaning 8 quarters, 12 quarters, 16 quarters, like long period of times, right? And you, from there, you need to stretch long enough, then only you can see the growth. So this is what I mean by, you know, watching paint dry. Things doesn't just show up within a couple of months just because you have invested, right? So that's the difference in terms of the perspective. I would strongly encourage you all to, you know, especially for the newer investors, focus on the fundamentals and then focusing on the long-term trend and learn how to be patient and wait for the business grow to kick in. I know for those who are new, you just started, let's say your investing experience is less than, let's say 2 years. You have this, like impatience to want to see results, right? But once you have more experience, like you stay in the market for longer, after you have watched some companies able to grow meaning that they grow a lot, but also take some time, right? For example, like 5 years, 10 years to grow a lot, right? Then you know like, okay, that's the one that we want to bet on. So this is just the example for Nvidia. I mean, their growth is mainly from the data center business. So I think, and the key point here is not, it's really like you need to have long period of time. Every one of these bar here is 1 quarter. If you look at 6 months, basically, I'm just showing you 2 quarters only, like 2 bars. 2 bars, like even if you go back to, let's say 2023, right? Just focus on the bottom period here, right? 2 bars is just like, okay, if you focus on 2023, I think their calendar is quite weird one, their financial year naming conventions, right? If you look at this, it's like, oh, it drops some more, right? Then waste of time. You really need to zoom out to see whether the business is good or bad. So that's my take here. Okay, like I said, you can focus on revenue. Revenue is just one example. If you not happy with revenue, you just look at their gross profit, you look at their operating profit, you look at their net profit. I think everything looks good. I mean, for Nvidia, their business in terms of their margin is very healthy. So this is, I find this view for those, especially for those who are not good at, let's say, like financial statement, right? You look at all the numbers, you get dizzy, right? Then I think you can follow this app economy insights. They always like look at the financial statements and then just break it down on like how the financial statements work. This is essentially the income statement, right? Income statement shows that where's the revenue, the total revenue, and somehow it breaks down by different lines. Like for Nvidia case, it's like how much came from the data center, how much came from the gaming, professional visualizations, automotive, and so on. And then from the revenue, part of it will flow to the gross profit, and then part of it will flow to the operating profit and net profit. And then from there will be the free cash flow, and they will use all this free cash flow to do some dividend payment and share buyback. That's how the money accrued to the shareholders, right? So I find this chart here is very, very useful, especially for those who don't like to read the financial statements. So I'll just quickly go through the chart like I mentioned. Every bar here is 1 quarter. So usually I just use Coifin to generate whatever that I want to look at. But for those who are familiar with my channel, I usually just plot the key things. For example, the revenue, the net income, the free cash flow. I mean, these are the key ones. Usually I look at last 12 months because for quite a number of companies like Apple, right? Let's say like Q4, their business is better than other quarters. So you want to smooth out the quarters, what you can do is just plot the 12 months rolling. But here for Nvidia, just because their businesses is ramping so fast, right? We can't see the seasonality yet. Every quarter is just like keep on ramping up, right? So here I plot the just every quarter. So this is financial quarter, right? The recent revenue is 44 billions. You see like just a one straight line ramping up because there's so much demand that they need to meet, right? So it's all about like scaling their manufacturing, and by manufacturing, it's not Nvidia doing the manufacturing. They have their partners to do that. So, but I think the key point here is like the quarterly manufacturing, all this scale continue. And then if you look at the net incomes, there's a dip here. Of course, this is like a one-off event because suddenly they are told they can't ship their products to China. So it's like a sudden lockdown. They can't ship it out, right? So all these products that is meant to ship to China because they can't sell it, so they have to do a write down. So that one hit their net income. Without this net income write off, right, it is like one straight line up, another up, not down. So this actually affect them quite a fair bit. And for those who, if you can recall, after the news came out, right, actually the price took a big hit, right? It's just after the earnings came out, right? I mean, this part, yes, there's a impact, but for the general growth of the business, it still exceed the expectations. That's why their earnings results was quite good. That's one thing. And then free cash flow, because free cash flow is not affected by all this write down, right? So you can see that free cash flow really $26 billion just in one single quarters. That is very, very high numbers. So this is the true reflect the true growth in terms of their fundamentals rather than this net income just because of the write down. But the China things, definitely it is a a significant hit to the business because China, right, the market is quite big. Of course, one China is not bigger than the world excluding China. I'm not saying they are that big, but still it is very significant. They are still buying a lot from Nvidia in the previous quarters, right? And so the problem now is that US government stop allowing them to ship to China. They don't have a product right now. In future, whether they will have a product or not, still need to see. By setting expectations, I think China, you need to expect that there's no more data center chips go to China. So basically their market, one part of the market just, cancelled. Nothing come from there. So it is a bad news for the shareholders. But now we just focus on the markets excluding China. Hopefully they are still growing. I agree with Jensen's. Let's say if US government, right, they shouldn't do these things, right? Because if you stop Nvidia to ship to China, what happens is that then it provides a market for companies like Huawei to serve, right? Whereas let's say if you continue to sell to China, then because their chips is better than competitions, right? So all these GPU buyers, they will buy Nvidia chips, and then it will be less lucrative for Huawei to develop. Now it's just like suddenly their market is a lot bigger, right? So from competition's point of view, I think this is a bad move by the US government because sooner or later, China, they will have their homegrown chips, homegrown products, right? So even if they can slow down, probably they can slow it down by, let's say, 1 or 2 quarters. There's no point one. So because they have so much deficit with China, right? Why not letting Nvidia to ship to China and then help with the closing the deficit, right? So that's what I'm thinking. So I don't agree with US government action in this, but this is geopolitics, right? So what can we say? But good thing is that the other part is still growing. Okay, now come to the valuations. I think valuation-wise, this is forward PE during, let's say, like the April period, right? During Liberation Day crash, right? It went down to as low as, let's call it like 23, or 22. From forward PE perspective, definitely doesn't look expensive for the companies, even with, the share price close to all-time high, right? The reason is because when it comes to the business growth, right, it's still scaling. So like I said many times in the past, it seems that if you look at this forward PE, right, what it tells us is that market actually don't believe they can grow at current growth rate for longer than, let's say, 2 years. They are expecting it to normalize or even come down. If not, it shouldn't be at this kind of low PE, right? Given that their growth rate is still super high. Jensen keep on saying that there's plenty of demands in terms of their chips. I think that's the things. Talking about short term and long term again, right? I know for those who focus on short term, whether they look at share price or they look at the quarter to quarter growth rate, right? That is like a short term view, right? To me, you want to buy into a company, you need to know where the company is. Let's say like two years from here or 5 years from here. Of course, when we talk about 5 years, it's all about like nobody can guess so far ahead. But at least you need to be able to imagine where the trend is going, right? So that's why I use this chart. This is not my chart. This is actually coming from Nvidia. So they're plotting this data center capex coming from Dell Oro projection. I don't know what is this, but anyway, it's just some things that they quoted. Okay, they are basically telling us that there are research being done, and that research tell me that the data center capex is ramping up year over year. I think, let's say, if you look at historical data, also it's like going up, right? I mean, it's normal. Economy is growing. All this IT data center is growing. Data center capex is going up. It's also normal, right? So it is projected to continue to go up. And then if you look at Nvidia, that data center revenue is also going up from 2022 to 2023 to 2024. The question now is that if you just close your eyes and imagine 2028, right, where would be their revenue? So from this chart here, I would say that easily they can come up with, let's say, I don't know, maybe 200 plus, 300 billions of Nvidia data center revenue. And today's their revenue, just look at the 44 billions quarterly revenue, right? I think if you multiply by 4 plus some minor growth rate, right, we are talking about, let's say, 200 billions of total revenue, not just data center, total revenue. So from 200 billions can grow to what, 300, 400 billions? That is still a decent growth, right? So I think that's the things. Need to look ahead. And by looking ahead, you want to know what kind of market that they are in, and then whether that market is growing or not. And second thing is you need to ask yourself like whether they are able to maintain their share or not. So basically, that's my high level thinking models when it comes to this. Because if you have numbers like this to guide you in terms of projecting their numbers ahead, right? Let's say if you look at 1 quarter to 1 quarter, let's say there's some slowdown, right? You won't be that panicked, right? Because you know that you are betting on the industry, the growth of the industry. So I think that's the things that I will look at now. That's the data center growth. And then I think the other thing is that every quarter, right, analysts sure ask Jensen one, like, do you see things slowing down? Do you still think that it's growing or not? And then Jensen is also very patient at answering the same question again and again. Every quarter, just want to assure you that, we still see the demand is there. And it's not just one statement like, I think the demand is there. It's not like that. He really try to help the analyst to reason like why he thinks that the demand will continue. Say for example, this is the trend, right? Before they have all the what they call the thinking model or test time scaling, right? The one that we use, let's say like the O3 models where the LLM continue to talk to itself before they come up with the response, right? So he really helped us to think through this, to reason through this, to say that, okay, if let's say how we use LLM is just like, okay, one shot kind of prompt, right? One shot prompt, you prompt and then they come back with results, right? That is a lot less tokens required as compared to inference, right? Where you need to this kind of, what they call it, test time scaling, where they have to really talk to itself for a very, very long time. Let's say if you ask the LLM to run codes for you, they actually do the debugging itself, read the error message and then go back and debug the codes again and keep on going, right? Just one prompt and then the amount of token that is needed is just so much bigger and the output is so much better. So with that, right, actually the token demand is like a lot larger. And we are not even in the agentic world yet, right? I mean, agentic prompting, all this is still far ahead, right? So I think the change of the technology from time to time just tell us that the demand for all these tokens is just going to go up. Then aside from that, there's a lot on the adoption side, right? Whatever products that people are using, the adoptions haven't even started yet. The only things that we are using now is, let's say like the ChatGPT, right? In the future, the entire running of the enterprise will use all these technologies. So you can tell, right? The amount that we are using versus what is needed in the future, right? We are talking about like different orders of magnitude. We're talking about like, okay, you think today compute power is enough? We need 10x more. Then you think that 10x more is enough? We need another 10x more. So that's the kind of demand that is needed. And that's why when it comes to the product, good thing is that the product that they're coming with is really those, very advanced. The advancement is like, it's not like every year we come up with something that is 20% better. It's not like that. It's really a lot steeper. Of course, that is coming from multiple different advancements. The cheap one is only like one small part. There's also advancement in terms of the algorithm. The algo also getting more efficient over time, and the memory also getting better over time. The model also getting better over time. So there are many things that help them to come up with the increase in efficiency, right? So I think, after you talk about this, right, I think the key point to summarize is that demand, right, is not slowing down. That's why you look at the capex also haven't slowed down. While waiting for these things to slow down, right, their revenue just keep on showing this kind of picture to you. So I think that's the thing about the business. In terms of the product, just a quick one is just to show you their roadmap for 2025, 2026, 2027. Even 2028 is all shown here. I won't go into a lot of all these details. If you want to find out all this, right, you can just watch their GTC event, right? So that one, there's a lot of details there. Okay, thank you so much for joining. Enjoy meeting you all. There are 49 people here. Happy to interact with you all. See you in the next one. Bye-bye.